What would you do right now, today, if someone handed you $100 billion and said, it's yours to invest? Every decision is yours. Every gain is yours. And every loss is yours too. Would you panic? Would you freeze? Would you start Googling, what is a hedge fund? Most people would. And honestly, that's okay. Because the truth is, the people who actually run $100 billion hedge funds, the Ray Dalios, the Ken Griffins of the world, they didn't start with $100 billion. They started exactly where you are, confused, curious, with a little bit of money and a whole lot of questions. Today, I want to walk you through what your life would actually look like if you were running a $100 billion hedge fund. Not the fantasy version, not the Hollywood version with the private jets on the first day. The real version. The decisions you'd make, the pressure you'd feel, the strategies you'd use, and most importantly, the lessons buried inside all of it that you can actually use with whatever you have in your account right now. Because here's what most people get wrong about money. They think the gap between someone with $1,000 and someone with $100 billion is just more zeros. But it's not. The gap is wisdom. The gap is behavior. The gap is knowing things that most people were never taught. So let's close that gap, starting right now. Okay, day one. You wake up and you are in charge of a $100 billion hedge fund. First thing you feel is not excitement. It's weight, immediate, suffocating weight. Because that $100 billion doesn't belong to just you. It belongs to pension funds, to university endowments, to insurance companies. There are real people, real teachers, real nurses, real retirees whose retirement savings are sitting inside your fund. Their futures are tied to your decisions every single morning. That feeling, that sense of responsibility is the first lesson. The most successful investors in history talk about it all the time. Warren Buffett calls it playing with other people's money. Ray Dalio built an entire investment philosophy around the idea that you have a duty to protect capital first, grow it second. And what does that teach us? It teaches us that the first rule of building wealth, whether you have $1,000 or $100 billion, is don't lose it. That sounds painfully obvious, but you'd be shocked how many people violate it every single day. They put all their money into one stock because a cousin told them it was going to the moon. They day trade on emotion. They chase whatever's hot right now. They treat investing like a casino, and then they wonder why they keep walking out broke. The number one job of a great investor is not to get rich, it's to not get poor. Protect what you have first, then grow it. So now you've got this weight on your shoulders and you need to build a portfolio. $100 billion sitting in cash is worthless. It needs to be deployed. It needs to work. Where do you start? You start with diversification. And I don't mean the lazy version of diversification that most people think about. I'll buy 5 different tech stocks. I mean real diversification, the kind that protects you when the world falls apart. Here's what a real $100 billion portfolio might look like. Maybe 30 to 40% in equities, stocks from different sectors, different countries, different sizes of companies, not just American tech. You'd own healthcare companies in Germany, consumer brands in Japan, energy companies in Brazil. Because when the American economy sneezes, you don't want your entire portfolio to catch a cold. Then maybe 15 to 20% in bonds. Boring? Yes. Necessary? Absolutely. Bonds are the seatbelt in your financial car. You don't appreciate them until you crash. Then real assets, real estate, commodities, gold, infrastructure. Things that hold value when paper money gets weird. When inflation spikes and your dollar buys less, real assets typically hold their ground. And then, this is the part that makes hedge funds different. You'd hold some alternative investments, private companies before they go public, distressed debt, event-driven plays around mergers and acquisitions, things that don't move in the same direction as the stock market. The goal of all of this is correlation. You want your investments to not all go down at the same time, because when they do, and at some point they will, you need something holding steady so you don't have to sell everything at the worst possible moment. Now, you might be thinking, that's great for $100 billion. I've got $400 in my savings account. What does this have to do with me? Everything, because the principle scales down perfectly. Even with $400, you can diversify. Index funds let you own tiny pieces of hundreds of companies at once. A simple 3-fund portfolio, a US stock index fund, an international stock index fund, and a bond index fund, gives everyday people the same diversification that took financial advisors decades to figure out. The rich don't have access to magic. They just apply timeless principles at a bigger scale. All right, your portfolio is set. Now comes the part nobody talks about enough: managing your own psychology. You are running a $100 billion hedge fund, and the market just dropped 15% in 3 weeks. Your fund is down $14 billion. The phones are ringing, investors are emailing. Someone leaked to a financial news website that your fund is struggling, and now there are articles about it. Your team is looking at you. Your analysts are scared. Everyone wants to know what you're going to do. What do you do? This is the moment that separates the legends from the cautionary tales. The legends, the ones who built dynasties, they do something that feels almost impossible in that moment. They get quieter. They slow down. They go back to their process. They ask, has anything actually changed about the fundamental value of what I own? Or is the market just scared right now? There is a profound difference between price and value. Price is what you see on a screen on any given day. Value is what something is actually worth based on earnings, growth, assets, competitive advantage. Price swings wildly based on emotion, news cycles, fear, greed. Value moves slowly and predictably. When Ray Dalio was building Bridgewater, he went through periods where his fund was down significantly. When George Soros made the trade of his life, shorting the British pound in 1992, he had been sitting on that thesis for months while other people thought he was crazy. When Warren Buffett bought Washington Post Company stock in the 1970s and people laughed at him, he was paying about a quarter of what he estimated the company was actually worth. He didn't care what the price did in the short term. He knew what it was worth. That discipline, that ability to separate price from value and to hold your conviction when the crowd is running the other direction, is the single most valuable skill in investing. And it has nothing to do with math or spreadsheets. It's emotional. It's psychological. It's about knowing yourself well enough to not let fear or greed make your decisions for you. This is just as true for you at home, by the way. When the market drops 20% and everyone on the internet is saying sell everything, the thing that will protect your financial future isn't a hot tip. It's the ability to sit still, to remember why you invested in the first place, to understand that volatility is not the same as loss, and that loss only becomes permanent when you sell. Every market crash in history has eventually recovered, every single one. The people who held on, or better yet, bought more during the crash, came out ahead. The people who panic sold locked in their losses and then watched the recovery happen without them. Don't let fear make your decisions. That's true whether you have $100 billion or $100. Let's talk about something that your $100 billion fund does that almost no everyday investor does, and it might be the most important thing I say today. Stress testing. Every quarter, sometimes every month, your risk team sits down and runs what are called stress tests. They ask, what happens to our portfolio if interest rates go up by 3%? What happens if there's a global recession? What if oil prices drop by half? What if a major government defaults on its debt? What if there's a pandemic and the entire world shuts down for 6 months? They model every nightmare scenario they can think of, and they look at how each one would affect the portfolio. Not because they think all of these things will happen at once, but because they want to know their vulnerabilities before the world exposes them. This is called scenario planning, and the reason it's so powerful is that it forces you to think about risk in advance when you're calm, rather than in the middle of a crisis when you're terrified. Think about how you could apply this to your own life. Sit down sometime and ask yourself, what happens to my finances if I lose my job tomorrow? Could I survive 3 months? 6 months? What if my car breaks down and the repair costs $2,000? What if a medical emergency hits and I have a $10,000 hospital bill? What if the market drops 40% and I see my retirement savings cut in half on paper? If the answer to any of those questions makes you feel physically sick, that's important information. That means you have a vulnerability, and vulnerabilities don't go away just because you don't look at them. They just wait for the worst possible moment to surface. The greatest gift you can give yourself is clarity about your actual financial situation, the good, the bad, and the scary, because clarity gives you power. When you know your vulnerabilities, you can start addressing them. Build an emergency fund, lower your fixed expenses, diversify your income, reduce debt. Each one of those moves is like adding armor to your financial life. The hedge fund manager stress tests the portfolio. You should stress test your life. Now let's get into something that really opens people's eyes. How does a $100 billion hedge fund actually make its money? Because this is where it gets interesting and a little bit complicated, but stay with me because there's something in here that will change how you think about money forever. There are a few major strategies that top hedge funds use. Let me walk you through 3 of them, and then I'll show you how the principles hidden inside each one apply to your everyday financial life. The first strategy is called long-short equity. This is when you buy stocks you think will go up, those are your long positions, and simultaneously bet against stocks you think will go down, those are your short positions. The beauty of this is that you can make money regardless of whether the overall market is going up or down. If the whole market crashes but your short positions do better than your long positions, you still come out ahead. What's the everyday takeaway here? It's this: don't rely on one source of income. The people who get absolutely devastated by economic downturns are the ones whose entire financial life depends on a single employer, one paycheck, one income stream. If that goes away, everything goes away. The hedge fund builds multiple positions, some growing, some hedging against risk. You can do the same thing. A side hustle, freelance income, dividend-paying investments, rental income, a small online business. These aren't just ways to make more money, they're insurance policies. They're your financial short positions. When one thing goes wrong, something else holds you up. The second strategy is called global macro. This is Ray Dalio's specialty. It's when you make big bets based on broad economic trends, interest rates, currencies, trade policy, economic cycles. These managers are thinking years, sometimes decades into the future. They're asking, where is wealth actually flowing in the world right now? Which countries are rising? Which are declining? Is the dollar going to weaken? Is Asia going to outgrow America? The everyday takeaway from global macro is to think bigger than your own neighborhood. Most people's financial plan is entirely based on what their local economy looks like. They buy a house in one city. They invest only in American stocks. They think about money in terms of dollars and nothing else. But the world is enormous, and capital flows to opportunity. You don't have to move to another country or become a currency trader, but understanding that global economic trends affect your life and finding simple, low-cost ways to participate in global growth, like international index funds, puts you in a completely different position than someone who is only watching the local news. The third strategy is called event-driven investing. This is when you make investments based on specific corporate events, mergers, acquisitions, bankruptcies, spin-offs. A company announces it's going to acquire a competitor. Before the deal closes, there's usually a gap between the current stock price and the acquisition price. Hedge funds swoop in and profit from that gap closing. The everyday takeaway here is about paying attention to transitions and disruptions. The biggest financial opportunities in everyday life often come during moments of change. Companies get disrupted, industries transform, new technologies create new winners and losers. The people who recognize those shifts early and position themselves accordingly, whether it's investing in an emerging sector, upskilling into a growing industry, or starting a business that serves a newly created need, those are the people who end up ahead. Don't just react to change, anticipate it. Let's take a breath for a second. I want to step back from the strategy and talk about something more personal. Because if you were really running Miss Fund, if you had $100 billion under management, the decisions you'd be making every day wouldn't just be about numbers. They'd be about people. Your team, your analysts, your traders, your risk managers, the people who come into work every morning and give everything they have to execute on your vision. And here's something that the best fund managers all understand. The quality of your decisions is directly tied to the quality of your environment and the quality of the people around you. Ray Dalio built what he calls an idea meritocracy at Bridgewater. Every idea, no matter who it comes from, a 23-year-old junior analyst or a 30-year veteran, gets judged on its merits, not on who said it, not on their title, not on how confidently they said it, on whether the idea is actually good. This flies in the face of how most people and most organizations work. Most places, the loudest person wins, the senior person wins, the most confident person wins. But confidence and correctness are not the same thing. Some of the most confident people in history have been catastrophically wrong. And some of the quietest, most uncertain-sounding thinkers have been right about things that changed the world. Building an environment where truth can actually surface, where people feel safe saying, "I think we're wrong about this," where bad ideas can be challenged without politics and ego getting in the way, that is one of the hardest and most important things a leader can do. And this applies to your personal life in ways you might not have considered. Who are the people around you who will tell you the truth about your finances? Not what you want to hear, the truth. Do you have a trusted friend, a mentor, an advisor, a partner who will look at what you're doing with money and say, "Hey, I think you're making a mistake here"? If you don't, you need one. Isolation is one of the biggest risk factors in personal finance. People make terrible decisions in isolation. They convince themselves things are fine when they're not. They ignore problems until they become emergencies. They get excited about bad ideas and have no one to pump the brakes. Find your advisory board, even if it's just one honest person. Okay, we're about halfway through the life of running this $100 billion fund, and things have been going pretty well. You're up 12% over the past 2 years, your investors are happy, you're getting mentioned in financial publications as a rising star. And then it all falls apart. Not because of anything you did wrong, not because of a bad investment call, but because of something you never saw coming. A geopolitical event, a technological disruption, a regulatory change that completely rewrites the rules of one of your biggest sectors. This is what the industry calls a black swan event, a term popularized by author and former trader Nassim Taleb. Events that are rare, extreme, and almost impossible to predict in advance, but that in hindsight seem obvious. The 2008 financial crisis, the dot-com collapse, the COVID-19 pandemic. How do you survive a black swan when you're managing $100 billion? First, and this is crucial, you have to acknowledge that you don't know what you don't know. The failure of almost every major financial collapse in history comes back to this. Someone, somewhere, was so confident in their model, so certain they had everything figured out, that they stopped asking, "What am I missing?" And the thing they were missing destroyed them. The humility to say, I might be wrong, is not weakness. It is the most powerful tool in an investor's toolkit. Second, you maintain liquidity. This is a concept that sounds boring, but will save your life in a crisis. Liquidity just means having access to cash or easily sellable assets when you need them. $100 billion fund that is completely illiquid, everything locked up in 10-year private equity deals and 5-year real estate developments, has no ability to react when the world changes fast. In your personal life, this is your emergency fund. This is why financial planners beat the drum about having 3 to 6 months of expenses in cash. Not because they think something is always about to go wrong, but because when something does go wrong, and eventually something always does, liquidity gives you options. It gives you time. It gives you the ability to make decisions from a position of strength instead of desperation. The person who has cash in an emergency gets to choose their next move. The person with no cash gets to watch someone else choose for them. Third, and this is something that the best fund managers embody more than almost anything else, you stay the course on your long-term thesis while being flexible on the short-term execution. What does that mean? It means your fundamental belief in why you're investing, why you believe in owning equities for the long term, why you believe in diversification, why you believe in the basic principle that good businesses grow in value over time. That doesn't change just because a crisis hits. That's the foundation. It's been tested through world wars, depressions, pandemics, and political upheaval, and it has held. What does change is how you execute. Maybe you rebalance, maybe you shift some allocation, maybe you move toward more defensive holdings for a period. You adopt the tactics while keeping the strategy intact. Don't throw out your principles because the market is having a bad week. Now, let's talk about fees, because this is something that even sophisticated investors often overlook, and it is genuinely one of the most powerful concepts in all of personal finance. Hedge funds typically charge something called 2 and 20, 2% of all assets under management every year, plus 20% of any profits. On a $100 billion fund, that 2% fee alone is $2 billion a year, before any profits are even made. Those fees exist because hedge funds provide sophisticated strategies, access to markets ordinary investors can't reach, and ideally, risk-adjusted returns that justify the cost. But here's the thing. Most hedge funds, most of the time, do not beat the market after fees. Study after study, decade after decade, has shown that the vast majority of actively managed funds underperform a simple index fund over long periods of time. Not because the fund managers are stupid, many of them are brilliant, but because the fees compound in the wrong direction, and because consistently beating the market is genuinely extraordinarily hard. This is why John Bogle, the founder of Vanguard and the inventor of the index fund, might be the most impactful investor in history for everyday people. He didn't have a fancy strategy. He didn't chase alpha. He said if you can't reliably beat the market, just own the entire market, charge almost nothing for it, and let compounding do its work over decades. In 2008, Warren Buffett made a famous 10-year bet with a hedge fund manager. Buffett said a simple S&P 500 index fund would beat any hedge fund portfolio over 10 years. He was right by a landslide. What does this mean for you? Watch your fees. Not obsessively. Don't become someone who spends more time worrying about a fraction of a percent than actually investing, but intentionally. The difference between a fund that charges 1% per year and one that charges 0.1% per year might sound tiny, but over 30 years of investing, that difference compounds into tens of thousands, sometimes hundreds of thousands of dollars in your pocket versus in someone else's. Fees are invisible taxes on your wealth. Keep them as low as possible. We're getting close to the end of your first chapter running this fund, and I want to talk about something that doesn't get discussed nearly enough in the world of finance. Purpose. Why does it matter? What is all of this actually for? The most successful hedge fund managers in history, the ones who didn't just make money but actually changed things, they weren't motivated purely by the number. The number is a result, it's a byproduct. What drove them was something deeper. Ray Dalio wanted to understand how the economic machine works, genuinely, at a fundamental level, and he wanted to build an institution that could outlast him. His purpose was understanding and legacy, not just wealth. George Soros made his billion-dollar bet against the pound partly because he had been studying currency mechanisms for years and believed he understood something the market hadn't fully priced in yet. His purpose was intellectual, proving an idea correct. For many investors, the purpose is freedom. Not just freedom from financial stress, though that matters enormously, but freedom to do the work you actually care about, to spend time with the people you love, to give generously, to build something meaningful. And here's what I want you to hear. This matters for you too, maybe especially for you. Because one of the biggest reasons people fail to build wealth is that they never get really clear on why they're doing it. They know they should save money. They know they should invest. But there's no emotional pull behind it. There's no vision connected to the behavior. And without that, the first time you face temptation, a vacation you can't really afford, a car that's just a little bit nicer than you need, a gadget that you definitely don't need but really, really want, you cave. Because I should be saving money is not a strong enough reason to say no to something that feels good right now. But I am building the life where I can afford to never take a job that kills my soul. That's a reason. I am building security so that when my parents need help, I can give it without hesitation. That's a reason. I am building wealth so that my kids have options I never had. That is a reason. Get clear on your why. Write it down. Put it somewhere you'll see it. And the next time you're about to make a financial decision, a purchase, an investment, a choice about how to spend your time, ask yourself, does this take me toward that vision or away from it? Let me bring this home. You've been running this $100 billion fund, and you've learned things that most people spend entire careers trying to figure out. Let me give you the condensed version, the things you'd carry with you out of this experience. First, protect capital before you try to grow it. Don't lose what you have. Build your emergency fund before you start investing in anything. Eliminate high-interest debt before you start trying to get rich in the stock market. The foundation matters more than anything built on top of it. Second, diversify. Really diversify. Not 5 stocks, not just American companies, not just your employer's industry. Spread your risk across asset classes, geographies, and time horizons. Make sure not everything in your financial life can go wrong at the same time. Third, your psychology is your biggest asset or your biggest liability. The market will scare you. It will get greedy and it will get terrified, and it will try to pull you along with it. Develop the habit of sitting still in discomfort. Don't let the noise make your decisions. Come back to your fundamentals. Remember why you invested in the first place. Fourth, fees matter, quietly and permanently. Index funds, low-cost diversified investments, the power of compounding left uninterrupted. These are tools available to everyone, not just the wealthy. Fifth, build multiple income streams. Don't let your entire financial life rest on one source. Diversify your income the same way you diversify your investments. Sixth, stress test your life. Know your vulnerabilities before they're exposed. Build for the bad scenario, and the good scenario takes care of itself. Seventh, stay liquid. Cash is not the enemy of growth. It is the prerequisite to surviving long enough to grow. Eighth, think long-term. Not just in investing, but in everything. The best decisions you will ever make are the ones where you delayed gratification today for something far better tomorrow. The people who run $100 billion funds are almost never thinking about next quarter. They're thinking about the next decade. And finally, know your purpose. Know why you're building. Give your money goals an emotional anchor. Because discipline without motivation is fragile. But when you're building towards something that genuinely matters to you, you will surprise yourself with what you're capable of. Here's the thing I want to leave you with. Running a $100 billion hedge fund is extraordinary. It's a level of financial power that almost no one on earth ever experiences. And yes, it comes with complexity and pressure and stakes that most of us will never face. But the principles, the underlying wisdom, the behaviors and mindsets that separate the people who build lasting wealth from the people who always wonder why money seems to slip through their fingers, those aren't locked up behind billion-dollar doors. They're available to anyone. They're available to you right now with whatever you have. You don't need 100 billion to start thinking like someone who has 100 billion. You just need to start. Open that investment account. Set up that automatic transfer. Build that emergency fund dollar by dollar. Read one more book about money. Have that honest conversation with yourself about where your finances actually stand. Every great fund in history started with a decision. One person deciding that they were going to be serious about money, that they were going to learn, that they were going to apply discipline and patience and clarity when everyone around them was doing something else. That decision is available to you. It has always been available to you. The only question is when you're going to make it.